So what if you could spot a market reversal before it actually happens? Now, it's not magic. There's an indicator designed to do just that, and it works by measuring one absolutely crucial factor: momentum. Let's dive in and break down exactly how it works. You know, the biggest trap for so many traders is using tools that only tell you what has already happened. You spot a trend after it's been going for a while, and by the time you jump in, you're just late to the party. This is the classic problem of lag. And this brings us to a really important distinction. On one side, you've got your lagging indicators, like moving averages. They're great for confirming a trend that's already in full swing. But on the other side, you have leading indicators, like the RSI, which try to give you a hint, a little clue about what might happen next. It's a completely different tool for a totally different job. Okay, so the solution to this whole lag problem is an indicator that basically acts like a speedometer for the market. It doesn't just care about the price, it cares about the speed and the force behind those price changes. And that tool, my friends, is the Relative Strength Index, or RSI for short. Let's really break that down for a second. The RSI is, at its heart, a momentum indicator. It's not telling you if a price is good or bad. Nope, it's telling you how fast and how aggressively that price is moving up or down. It's trying to measure the collective psychology, the pure, raw energy behind a market move. Now, what makes the RSI so easy to use is its beautiful simplicity. It operates on this clean, simple scale from 0 to 100. That's it. It can never go above 100 or below 0, which makes it incredibly easy to read and understand in just a single glance. And this right here perfectly sums up the core logic. Just think about it in real-world terms. A car can't just accelerate forever, right? A sprinter can't keep getting faster and faster down the track. At some point, that energy gets exhausted. Well, the RSI is built on that exact same principle, that a market pushing too hard, too fast, in one direction will eventually run out of steam. And when it does, a reversal becomes much more likely. So, how do we actually turn this simple 0 to 100 scale into real actionable signals? Well, it all comes down to two critical zones that act like warning flags, telling us when the market's momentum and its emotions are stretched to the absolute limit. First up, we have the overbought zone. This is typically any reading you see above 70. This is a big hint that buyers have gotten a little too excited. They've pushed the price up way too far, way too fast, and euphoria is probably setting in. I want you to picture a rubber band being stretched upward. The more it stretches, the more tension builds, and the more likely it is to snap right back down. This is our cue to start looking for potential selling opportunities. And of course, the exact opposite is true for the oversold zone. This is any reading below 30. This is where sellers have pushed the price down too hard, and pessimism or even fear is starting to take over the market. Our rubber band is now stretched all the way down, just waiting for the moment to snap back up. And this is our signal to start hunting for potential buying opportunities. And what about that whole area between 30 and 70? Well, that's just the neutral zone. Momentum is pretty balanced, so the RSI isn't really giving us a strong signal one way or the other. This is kind of the wait and see area. But here's a pro tip. The most powerful signals often show up while the price is still trending hard, and that's when the pros start looking for something else entirely. Okay, so reading this overbought and oversold zones is RSI 101. But if you really want to use this tool like a pro, you have to learn how to spot a much more subtle signal called divergence. This is the secret clue that often appears right before a huge trend is about to turn on a dime. And that really gets to the heart of what divergence is all about. What does it actually mean when the price on your chart is telling you one story, but the momentum behind that price is telling you a completely different one? So here's the first piece of the puzzle. You look at your chart and you see the price is pushing higher and higher. It's breaking old resistance levels. It's making a brand new high. On the surface, everything looks incredibly bullish, incredibly strong. But then you glance down at your RSI indicator, and it's painting a very different picture. Instead of making a new high right along with the price, it's actually making a lower high. The momentum, the energy behind the move, is getting weaker even as the price itself is climbing. That disagreement, that conflict, is exactly what we call divergence. Look, divergence is a massive warning sign. It's telling you that the conviction, the energy behind that price move is fading. Yeah, the crowd might still be buying, but the force behind that buying is getting weaker and weaker. The trend is basically running out of gas, and a reversal could be right around the corner. All right, now that we have all the pieces, let's put them together into a practical, actionable rulebook. Because let's be honest, knowing what the RSI isn't enough. We need to know how to use it the right way.
And this right here is probably the single most important rule you need to remember. The RSI is a fantastic tool for finding potential opportunities, but it should never, ever be used all by itself. Think of it as a filter that helps you find promising setups, not a magic bullet that tells you exactly when to buy or sell.
So this all builds into a really simple 4-step checklist. First, you identify the zone. Is the market overbought or oversold? Second, you check for that hidden weakness. Is there any divergence happening? Third, and this is absolutely critical, you seek confirmation. Don't just act on the RSI alone. Look for another confirming signal, like a specific candlestick pattern or a big spike in volume. And finally, you always execute as part of your overall trading plan.
At the end of the day, the RSI doesn't give you all the answers, but what it does, and what it does so well, is it equips you to ask a much, much smarter question. It helps you look at a really strong trend and ask, is this trend really as strong as it looks? Or is it secretly getting exhausted? And being able to spot that difference, well, that's what can set you apart from everyone else.